More than 6.4 lakh retail investors are set to lose their entire investment in Jaiprakash Associates, not because the stock has merely fallen, but because the shares themselves are being wiped out. On 18th of June, Jaiprakash Associates Limited or JAL will be delisted from the BSE and NSE. Once one of India's most prominent infrastructure and real estate enterprises, JAL is now being taken over by Adani Enterprises through a 14,535 crore rupees insolvency resolution plan. Now for lenders, this means some recovery, but for shareholders, it means nothing. So how can a listed company's shares suddenly become worthless? Let's understand. JAL had been struggling under a heavy debt burden for years. In June 2024, the company entered the insolvency resolution process after failing to meet its financial obligations. Lenders invited bids to recover parts of their dues. In March 2026, the National Company Law Tribunal approved Adani Enterprises 14,535 crore rupees resolution plan. Now that gives the Adani Group control of key assets including JP Greens and JP International Sports City. Vedanta challenged the decision, arguing that its bid was roughly 3,400 crore rupees higher overall. But the appellate tribunal upheld the lender's choice, clearing the way for Adani's acquisition. Now what does delisting mean here? Delisting means a company's shares are removed from the stock exchanges, so investors can no longer buy or sell them through regular trading accounts. In many delisting cases, what happens is that shareholders may receive an exit offer. But JAL's case is different. This is not a voluntary delisting. It is part of insolvency resolution. Under the approved plan, the existing shareholding structure will be completely extinguished. So in simple terms, the current shares will cease to exist. As of March 2026, around 6.48 lakh shareholders held stakes in JAL. About 6.4 lakh of them were retail investors, collectively owning around 45% of the entire company. But under insolvency law, shareholders are last in line. Creditors are paid first. Shareholders receive money only if value is left after creditor claims are settled. So in JAL's case, there is not enough value left. Gaurav Sharma, head of research at Globe Capital, told Business Standard that in practical terms, JAL shareholders are expected to receive nothing after the delisting. He explained that JAL's borrowings are significantly higher than the value of its entire assets. He said, and I quote here, even if the entire asset base were liquidated, the proceeds would not be sufficient to fully repay creditors. Since equity shareholders rank last in payment priority, they are unlikely to receive any money in return. Jaiprakash Associates was once a symbol of India's infrastructure ambition. What followed were years of debt, delays, and financial stress that affected home buyers, creditors, and investors alike. Now its delisting closes one chapter and hands the next to Adani Enterprises. But for more than 6 lakh retail shareholders, there is no next chapter, only a hard lesson. When a company enters insolvency, equity investors do not just face a falling stock price. They face the risk of being wiped out completely. Follow Business Standard for more stories.